Hello, Propenomix people, and welcome to Sunday Supplement Live. And hello to the Property and Propenomix group as well. Nice to see you here today. So, for those who haven't listened before, I always like to kick things off with a quote, and I will do. This week's is, "It doesn't matter how slowly you go as long as you do not stop." And that's from Confucius, the quote goat, if you will. So I chose this week's quote to be deliberately provocative. Is that about leaving the country? Are we going to do a Rob Less or whatever his name is? Pretend to leave, say we're leaving 6 times, have 6 last ever appearances and courses in the UK, and then go on a long holiday and then come back? Does anyone care? Or does anyone even know what I'm talking about? Or is it about defecting on any political allegiances that might be long-standing and joining the new way? Solely because it's maybe better than the alternatives, because the alternatives are all absolutely woeful at this time? Or is it about leaving the industry altogether? Renters' rights? Blimey, if I see one more person put the apostrophe in the wrong place, I might need resuscitation. No apostrophe is better than an incorrect one if you struggle with that sort of stuff. EPCs on top of an overloaded camel's back? You, dear listener, can decide. After all those searching questions, Rod Turner and myself are running another workshop in July on Thursday the 3rd. That's joint ventures and mergers and acquisitions this time around, and it's sure to be a highly popular one. Here's a whistle-stop tour of the agenda. Market dynamics, JV opportunities, optimal legal structuring for property businesses, learning pros and cons of limited companies, all about share classes, shareholder agreements, sustainable JV models. Dive into capital structuring, comparing debt versus equity, managing risk and understanding personal guarantees. Gain insight into property M&A from due diligence to asset versus share purchases. Apply concepts through 2 in-depth case studies, acquiring an asset-backed property company and navigating a distressed business sale. Understanding strategic disposals, company wind-ups, and how to negotiate under pressure whilst maximising value. So don't miss the super early bird tickets for the workshop. They're now online and already selling like hotcakes at bit.ly/PBWSEVEN. And the link is in the comments and the show notes, folks, if you want to take a look. So welcome to the supplement proper. Business as usual now this week before we've got one more bank holiday. No one complains. Well, maybe the odd business owner does while the weather is like this. I do note the Monday forecast is for rain, though. The stock market continues to pretend like tariffs won't really happen now, although the shifts in how confident the world looks in the US from a global capital perspective and the weakness of the dollar and the bond yields looks more substantive. I'd be very surprised if Trump is just rolling over because the plan doesn't look that great. So the market looks to be a bit overconfident to me. Let's see. And that isn't a this week problem, seems to be the attitude that the market is taking. Deep dive wise, we're going to take a look at Savills' report about the housing challenge, as they prefer to call it, and also a peek at Shelter's briefing about the future trends in temporary accommodation in continuation of April's efforts in that department. I'm also going to include a peek at the MHCLG data on statutory homelessness as well. So straight into the real-time property market then. Thanks as always to Mr. Christopher Watkins' efforts for the week. Here comes that question we simply have to know the answer to. What is currently happening in the UK property market? Now we're 16 weeks into 2025 as far as the data goes. So pretty much a third of the year in, right? Remember, we run about 1 week behind with these figures, but it's as close to real time as we're going to get. And we see the listings data still pressing forward. 2025 still remaining the biggest start to the year for listings since 2015, we're told. Now, we've had our late Easter, and the 25-24 gap has narrowed, but we still have 15.7% more listings than the 9-year average, 6% more than our equivalent year to date in 2024, and we're 9% ahead of the pre-pandemic market. So my proxy data snippet to remember for context is there's 10% more stock than normal being listed or on the market. 32,500 new listings in spite of Easter Monday. So that train is still very much rolling. And once again, 13.4% of that stock has been reduced. So round about 1 in 7. Now that compared to 2024's average of 12.1 or about 1 in 8. And the 5-year average is 10.6%, which is more like 1 in 10. So more stock, more reductions, both in percentage terms and in absolute terms, because we've got more listings. So we've had another week with more than 20,000 price reductions around the country. In a bull market like 21-22, those numbers were 11,909 and only 8,374 accordingly. In a more normal market, they went a lot higher than that. So 2017-18, we saw 11,500 and 13,767 reductions. So we're seeing a lot of reductions in order to get sales agreed. I think that's also happening in the rental market, just as an aside. Rightmove published something this week saying 25% of the stock that's on Rightmove at the moment to rent has been reduced. So you could say landlords have pushed and found a rental ceiling for the moment. And they found that ceiling and they've gone too high, and now they're having their wings clipped back a little bit. That seems a pretty fair assessment. But of course, we've just had April, we've just had a wage rise. That will filter through into the system. People's affordability moves upwards. The train rolls on. Rightmove say about 4.5% up on the year. Asking rents are, despite all those reductions. So sales are a bit lower, but remember we did have Easter Monday in the data week that we're talking about here. So we're taking it into account, 22,800 sold subject to contract, still 11% better than 2024 year to date, and still 19% ahead of the pre-pandemic market. So plenty more sales happening, despite higher costs, higher transaction costs, particularly stamp duty, apart from anything else. So no real slowdown signs, just a week with a bank holiday in it, really. Plenty of business being done. Fall throughs at 23.6%, so just below the 7-year average, only just about 1 in 4, which is roughly where the average UK market looks like. You know, post the Liz Truss budget, you're at more like 40%. But yeah, 1 in 4 is about the proxy number that's right over the last 7 or 8 years. Still way ahead of 2024 in terms of net sales. And still way ahead of the pre-pandemic market in terms of net sales. So 10% ahead of 2024, 14% ahead of the pre-pandemic market in terms of the number of net sales. So just more being done, more volume is taking place at the moment. And this is well after the stamp duty cliff, of course. All of that has all gone, done and dusted. We don't have any immediate changes that we're sitting and waiting for at the moment. Although we do have probably a reduction in the base rate from the Bank of England in this coming week. And we have had a bit of a trim in the swap rates over the past few weeks since there was another wobble thanks to all the tariff stuff at the beginning of April. So in March, 5.75% of all sales in estate agency pipelines fell through. In 2024, that number was 5.36. So the stamp duty cliff did a little bit. Probably 7% more fall throughs than there were the year before, right? So did we hear about a bloodbath of deals falling through due to conveyancing being slow? I certainly didn't see much evidence of it at all. Perhaps it was a case that the industry did a decent job and they're just never going to get any praise for doing their job. I'm not sure. But I always give Chris a weekly shout out on here because he's more prolific than only this epic tome he releases weekly on the UK property market. He's got some great stats on a regular basis. So please drop him a like, a subscribe, and all the rest of it, and some kind words for his content creation. And if while you're here, you wouldn't mind giving me a like and a subscribe for my YouTube channel, Propenomix with Adam Lawrence, I'd much appreciate it if you're watching this on another platform. So thank you. So if you're in the industry and you want someone to help grow your business, you'd like a content ghostwriter or someone like that, or someone to help you be a more effective communicator, be more effective with your local market. That's Chris's core business ultimately. So give him a shout. If you want to read his article directly for yourself, it's on the Property Industry Eye website, and the video is always on his YouTube channel, which is at Christopher Watkin. Okay, it's macro time now. We've got a bit of a variety this week. First of all, nationwide house prices, then the Bank of England money and credit report. And then I've got to squeeze in the local election results here. I know this is not a political podcast in any way, shape or form, but I'm talking from an unbiased data perspective with a navel gaze as to what would the reform future look like? Because those who are not considering them being elected in 2028 or 2029 or whenever we get there are probably in denial, frankly. That leaves our contractually obliged space for the gilts and the swaps, of course. So Nationwide's figures, their own prediction came true, a haircut in the market for April. Nothing extreme, but a drop of 0.6% month to month. It gives all the people who want to try and get some clicks on the YouTube video, something to talk about when they start talking about the bubble bursting and all the rest of it. It's a complete nonsense, of course. It's exactly what you'd expect after a stamp duty hiatus like we've seen. It looks remarkably sensible compared to previous ones, to be honest. The total cost of buying a property is up about 0.8% from March on average. So that's very back of the fag packet. All I've done is £2,500 extra stamp on £300,000 purchase, the average sort of purchase these days. So very, very rough figures. Wouldn't be applicable to first-time buyers because they still wouldn't pay stamp up to 300. But the vendors eating some of that change very much makes sense, especially with the amount of stock there is on the market at the moment. But it's nowhere near as scientific as that anyway. We're talking about 1 month. I really don't think there's much to see here. The nationwide annual figure is at 3.4% growth, plenty of transactions, but we're talking 108,250. Now that compares to 150,000 plus in every stamp duty cliff month since 2015. And there's been a few of them, remember. And there were over 200,000 in the month when the main COVID stamp duty holiday came to an end. We were bumping in the sort of 90 to 100,000 transactions a month region in the build-up anyway. And my expectation would be 90 to 100,000 on a busier month in the calendar in this sort of market where we are today anyway. So there's been no major distortion from any of this. But my post-mortem would simply be the national attitude was, quick, we can save a bit. I mean, we love a bargain after all, don't we, in the UK? Rather than, oh my God, there's a huge incentive to save big lumps of cash here. That's certainly the sense I get from the data. And then the overall chatter from Nationwide, well, low unemployment, earnings rising in real terms, about 2% above the official figures are, 2% above inflation. So good stuff, about as steady as you like, really, with wages. Household balance sheets are strong. Borrowing costs should moderate. Swap rates have moderated in recent weeks, as I've already said. So I agree with all of that. It's very sanguine analysis there. And that's all they did for this month at Nationwide. So I'll move on to the Bank of England Money and Credit Report. Each month, the media generally focuses on how many mortgages were approved out of this survey, this release. It's a good real-time indicator of the health of the market. And bear in mind, only the deeply unrealistic would have expected a mortgage approved in March to complete by March the 31st. So that should be a pretty honest number of the state of the market. But as usual, I like to go a bit deeper. So the net amount borrowed was up gigantically. It was up to 13 billion net borrowed on the month. So for some context, that's bumping around the 2 to 3 billion mark for some months. And indeed in February, it was a net repayment. So that's a huge, huge increase, outsized increase, of course, sponsored by the stamp duty deadline. Now, this is confusing. We haven't had loads more completions, according to the data already analysed, but there's this gigantic increase in net borrowing. Well, perhaps the deadline was much more important for first-time buyers, and they pushed very, very hard. Remember, their pain point came between 300k and 425k. And their incentive to save, rather than being up to £2,500 on any transactions at 250k and above for the wider market, their incentive to save was actually £6,250 because they're paying 5% on the difference between 300 and 425. So in lots of parts of the country, it wouldn't really be relevant for a first-time buyer, but there's plenty of rooftops and plenty of places where that would be relevant for a first-time buyer. And if you can save 6,250 quid when you're moving into your first property, they're likely to be shorter of money than second steppers are as well. I think that argument's got a fair bit of merit, really. So when there is the data available to break that back, I'd expect all of the surge in March's transactions pretty much to be explained by first-time buyer transactions at high leverage. But let's see when it comes out. So the approvals for mortgages in March, 64,300. And I would expect April's number to fall again there, partially because of Easter, partially because we've seen this nationwide figure of 0.6% down. You know, they are using real-time data, their own data, from the number of mortgages that they're offering and all the rest of it. So I expect that to come downwards. But it's a tiny fall of 800 approvals between February and March. It's really nothing. 65k is the number for a pretty healthy market, to be honest. Anything below 60, it starts to become an area of concern. And that's what we've seen in the slower months of the last sort of 2.5 years, really. So that's a number I've been watching closely. Remortgages up by 1,000 on the month to 33,400. So they only record remortgages when you've moved provider. If you take a product transfer, which of course many people do, that's not recorded in the Bank of England survey. But it looks like no major bloodletting occurred from this stamp duty cliff really on the market. We're kind of 10% ahead of where we were on remortgages over recent times. Speculators being quite low, probably because the rates have been quite high. People have been hanging around and waiting for a little bit, whereas now I think they're more and more cultured to accept that this is the new way. These are the rates that we're going to be paying. Although, again, there's renewed chat at the moment that rates are coming down faster than they have done since the financial crisis. Rates are going to do this, blah, blah, blah. I'm still not on the bus there, folks, I'm afraid. I think we will have a cut next week. I think that's a guarantee, pretty much as close as you get in this game. I think we'll probably wait till August for another cut, and that might be us for the year. But we'll see. We'll see, because that will ultimately take us down to 4%. And I think we've got difficulties in going down below 4%. And as I've said throughout this, even though I've predicted the interest rate moves pretty well over the last 4 years plus, I'd love to be wrong, but I don't think I will be. Let's see. I've already moved from only 2 cuts this year to 3 on the basis of the very strong evidence that's been around and the concern about the economy over the tariffs. And of course, if the tariff facts change, I will change my mind once again. So I very much reserve the right to do that. Now, credit card borrowing decreased significantly in the month of March, only 200 million net borrowing. That's very, very low. Lowest figure since April 2024. And it certainly snapped off a trend for a month anyway that I'd identified recently of outsized credit card balance growth. So people concentrated on moving, they didn't concentrate on getting new credit cards by the looks of it, or maxing out their balances. Bank and Building Society balances were up 7.4 billion, typical end of tax year swell. The money supply also hit a new high, although we're only just above September, October 22 still. So inflation is unlikely to be dissipating at pace, as I've been saying for, well, years now, to be honest with you. But let's not get too excited by a cliff month. The figures look pretty healthy, particularly the ongoing mortgage approvals. Let's see if in April we dip below 60,000 approvals when we appraise that report next month. But that bump looks exactly like a bump at the moment when we consider the stamp duty changes, not a cliff, not a precipice. Okay, the local elections. Loads of propaganda without real context given. I really shouldn't have to do this, I feel, but then I always do seem to have to. So, firstly, you might not know all of the detail. I didn't, right? About 4,500 councillors in the UK are elected by thirds. That's what we call it. That happens where I live. 1/3 of the council is up for election each year, and on the 4th year, we rest. So every councillor is elected on a 4-year cycle. About 11,000 are elected by whole council. Council out, council in. Doesn't mean that the old councillors can't stand. Of course, there's still continuity, but everyone's elected all at the same time. So that's the majority of the way that the elections work at the council, at the local authority level in the UK. And then there's a very small amount that elections by halves, only about 300 seats. Half are elected every 2 years. Every other year is off. So of about 15,800 council seats, there are only 1,641 contested on the 1st of May. So only about 10% of the seats available were contested, and Reform won 41% of those 10% of seats that were contested. So the most bullish projection puts their share of a national vote, if we had one today, at 32%. And remember, Labour won a huge majority at 33% of the vote in 2024. Now, that seems high and unlikely because no polls have had them anywhere near that yet, although they have been in front. And most of the analysis has said 30 to 32%. That's the translation from the local authority election to the general election. Of course, the correlation is not perfect. You know, there's a campaign to run aside from anything else. Although at the moment, if you imagined one of them running a campaign, you'd probably imagine Farage doing the best job out of all of them as the best communicator, aside from anything else. Whether you love him, hate him, or don't really care and would rather keep calm and carry on, which is the camp, as usual, that you'll find me in. The press mostly focused on an embarrassment for Labour. They lost 2/3 of the seats that they did have. So they had about 300 up for grabs in this that they were holding. They're down to under 100 of those. And the Tories had a lot more seats to lose this time out, a load more seats to lose. And they lost about 2/3 of what they had as well. And the Lib Dems did well. They're a close fourth. So there's talk now about fracturing of the system. Will it work? Should we be using proportional representation? Blah, blah, blah. I don't know why we're talking about that so much when we've just seen a huge majority with a 60% turnout and a 33% of that vote. So, 20% of the country voted for Labour ultimately. No one's been moaning about that. Primarily maybe because most people were so happy the Tories were kicked out, although I'm not sure if they can remember those feelings now, because that was, nearly a year away now we had that election. So I'm not sure about this speculation that first past the post is all over. I don't think there is at all. But what I know from looking at these results sanguinely and calmly is that a reform government under our system is a real possibility. Now, I've been on that bus for about 3 to 4 months now. Not something I talk about broadly because outside of my wheelhouse, although I did do politics as part of my first degree, but ultimately what I'm interested in is what impact will that have on the macroeconomy and on the housing market. So I talked relatively openly about how concerned I was before the 2024 election about reform, because there was this fag packet economic manifesto and it looked like biscuits to me. It looked like disco biscuits, to be honest. Way, way worse than Liz Truss. And I've said as much. However, their defence to that scrap of paper is that in typical political chat, that was their long-term plan, not their day one plan. Well, thank goodness for that. The one major point that still worries me more than any other is that they insist on a belief that the UK economy can grow at 3 to 5% per year. And that plan just isn't credible and won't persuade any bond markets. As we know from recent experience, everyone is owned by the bond markets, even Donald Trump. However, what were their higher level plans? Well, no tax under 20k of earnings. Definitely progressive, helps the lowest paid for sure. Hugely expensive moving the personal allowance like that, of course. Some really serious shifting to be done. Inheritance tax to a 2 million threshold. Stamp duty abolished below 750k. Corporation tax back down to 20% and then down to 15% in year 3. So there is a timing on that one. Scrap IR35. Massive reductions in working age benefits, massive reductions in net zero subsidies, and foreign aid. Now, of course, since the election campaign, foreign aid has already been raided for future defence by the Labour Party anyway. Now, I think that their biggest issue that remains is Farage's view around NHS reform and insurance-based systems. Most pensioners, who of course have a higher predilection to vote, are massively outsized users of the NHS. They have no idea how much they cost the NHS as a whole because they just see it as free and they see it as an entitlement, as almost everybody does. Economically, of course, that viewpoint is wrong. It's highly costly, but depending on what age you are, depending on other things, you're either a net contributor or you're a net user of the system. And ultimately, the older you get, the vastly probability goes up and up and up and up. You stay in hospital for 3 months, probably costs about 200 grand, which will be, all the national insurance you've ever paid in your life for a lot of people, realistically. But people don't look at it like that, even though an economist would look at it like that if they're being realistic. But I think that's the one thing that still exists to sort of derail their campaign. Farage is going to need to really decide where he's at on the NHS and how he's going to communicate it, because their manifesto said they were going to put an extra £17 billion into the NHS. Now, remember, populists promise things that they can't do. That's what they do. That's how they get elected. However, as evidenced by Trump, they can also continue telling abject lies. According to him, gas, as they call it in the States, is down to $1.98 a gallon, even though there's nowhere in the US that sold any below about $2.50. And they can get away with it to their supporter base, although his approval ratings are not great at the moment. Still, I think we need to be aware of what will happen if they do win the next election, as that's a question I'm very much already asking myself. And remember, I'm a long-term thinker, right? Stamp duty off on houses under 750k. Well, that would be some move. It would free up the market massively. Now, remember, the deputy leader, Richard Tice, is a property man through and through, and so is unlikely to hurt the market. For social housing, there would be prioritisation for British nationals and British homes for British workers. But that's not about building more. It's just about reallocation, isn't it? Fast-tracking brownfield development, well, that could be a good idea, depending on contamination and things like that, of course. And incentivising innovation, whatever that means. It sounds gorgeously political, doesn't it, if you think reformer truly different to everyone else, I'm not so sure. So from a purely economic viewpoint, my main concern, well, what happens to the base rate, the gilt yields and the resulting swap rates? We'll see more as we approach the next election, because if this country is still in the same political limbo as it is today, or Farage keeps this momentum going for the next 4 years, and that's some task, remember, he will be absolutely exhausted by then. What will the bond markets do in the run up to the election? This time around, there'll be a much more proper manifesto needed that's actually costed, you would hope, and not with silly comments like take the money from the commercial bank deposits at the Bank of England. There was and is a few billion quid to be liberated there, but not 40 billion, not without punishing savers and borrowers accordingly, or basically taxing people in another way. Time will tell, but the event horizon or bloodbath, if they did get elected, which is what I feared, to me today looks a lot less likely. I recommend anyone listens to the Reform chair, Zia Youssef, be interviewed by Peston and McGovern on the Rest is Money podcast. It was about a month or so back now. His chat around this 3 to 5% growth is complete puffery, in my opinion, but then politics is. But he's a very measured, successful and calm individual. It removed a reasonable amount of my reform anxiety, or whatever you want to call it anyway. Okay, that was quite a segue, but I couldn't let the reform quake, or whatever you want to call it, go undiscussed. Back to business as usual, gilts and swaps. Open on the 5-year gilt yield this week, 3.983%, close at 3.995. No movement to report. It did decay to under 3.9 during the week, but then the yield started to rise on Friday as we got to the close. That was all after some US jobs data, which were much better than expected. Although they weren't incredibly outsized, actually, to be honest, but started to put the yields back up because, again, what it's saying is another reason for the Federal Reserve not to put the rates down, another reason for the Bank of England, therefore, to potentially follow suit in terms of what the Federal Reserve is doing. I'm not sure that relationship is going to hold as much as it ever was over the years because of the very different policies. And remember, like I said earlier, you've got this strange situation at the moment where the US stock market's kind of recovered from what Trump's been saying, but actually you've got fairly significant weakness in the dollar. So the thing that has changed is the DXY, or DXY as they call it, the dollar index against global other currencies. People don't want dollars as much as they did. That's the difference. They still want American companies. They don't necessarily want dollars. So I also wanted to say I had cause to have a bit of a shout on Facebook this week. I try not to, but if I do see one more post from someone who has sold up before considering what they're going to do with the money, I'm going to have to shout again. If you're exiting, for goodness sake, make your investment plans up front, not when you've sold the property. So many are realizing they've got a 4% savings rate if they're lucky, which will then be subject to income tax that's waning, and that 4% is waning at the moment for a time deposit, like a 5-year bond or whatever. And you can't even get 4% anymore. Inflation's at 3%. Net returns are equaling 3.2% total if you pay 20% tax, 2.4% total if you pay 40% tax. Even worse if you're an additional rate taxpayer. So you're losing when compared to inflation. And people are now realizing this because it's better than property. I mean, it beggars belief. Anyway, thank you for listening to my rant. The rant is over. So the rates overall look to be improving for the borrowers. The Bank of England meets next week and huge odds on to cut to 4.25. They will. Now, I'm going to predict 2 votes for a 0.5% cut. And that's the metric I'll really be watching on Thursday when the results come out. How many 0.5%ers are there? We will see. This will give us a huge amount of information. And that will be the thing that really impacts the bond yields. How many people vote for a 0.5% cut? We'll see. We'll see. So put your masks on. It's time to dive deep. So first, I'm going to kick off with the MHCLG numbers on statutory homelessness. This report that was published at the end of April on the gov.uk website is very positively spun. The number of households owed a duty to prevent or relieve homelessness was at a record level at the beginning of 2024 and has reduced each quarter since then, we are told. The proportion securing accommodation has also increased since the start of 2024. Might just be worth me making that distinction between homelessness prevention and homelessness relief. So you can imagine prevention is stopping it from happening in the first place, aka someone presents with a situation which in our world might well be a Section 21 has been served, right? And then relief is they are now already homeless and something has to be done in the now and that's where the statutory duties of the council lie. Now, they can sort so I'm not sure about the whole picture at the moment, really, because the proportion secure. We've got this government saying all these numbers have gone down. We're on top of this. All's good. The proportion who've secured accommodation, so the percentage securing accommodation, is better than it was at the beginning of 2024. So we hit the pandemic or the government-sponsored low at the turn of 2023-24, is what the numbers are saying. But then the reality, right? And this is what the report summary doesn't say. The number of families in temporary continues to rise and is at record levels. But the number of families in B&Bs has been falling for the last 3 quarters, as have the numbers who are in B&Bs over the 6-week statutory limit. We often forget that 6-week statutory limit exists because we very rarely see it observed. And I'm going to try, for a change, not to be too cynical here. Now, there's nearly no political capital here. It really does look like they might be trying to do the right thing. But the alternative interpretation is that the government knows there's nothing they can do, nothing they can actually think through that's politically palatable about the rising number in temporary accommodation. But they can sort the B&B situation out and try and take political credit from it on Question Time or Koonsberg or whatever. Now, you could say this week, depends how you feel about it, it's obviously been some pretty negative and pretty horrible stuff posted, actually, around Starmer calling for houses from landlords instead of hotels for housing asylum seekers. As the sanguine, sensible people have pointed out, this has been going on for years. You know, these contracts were renewed in 2019, and before that, they absolutely, these Compass contracts existed for housing asylum seekers. But of course, it's become politically a bigger and bigger deal. And of course, in fairness to the data, more and more people are entering the UK illegally. And still that's the case in spite of Starmer's foolish promises to smash the gangs and all the rest of it. We all knew that was never going to happen. So he's struggling with that at the moment. What doesn't really get said is that does take housing out of the private sector, and so does temporary. It takes it out of the PRS. Now, I have friends who have significant amounts of temporary accommodation who have told me it's not been unusual to see someone be evicted for rent arrears at 11 o'clock in the morning. Now, they're a family, so there's a requirement, statutory requirement for relief there for accommodation to be provided, and then be checked into another one of their properties that's used for temporary accommodation at 2 o'clock in the afternoon. The difference being now the rent is being sponsored by the local authority, and that rent is, and it depends where you are in the country, but anything from 15% in London, we're told by the figures, much as we believe them or not, and of course that will vary across London, all the way up to 300% more expensive in Yorkshire and the Humber. Yes, 300% more expensive. Certainly in areas that I see, the TA tends to be between 50 and 75% more expensive. And of course, there's provision involved. There's more that needs thinking about and doing apart from anything else. And it's a complex situation, but just understand that. So it does seem that there's someone with a heart there in the Labour Party trying to do something about the number of people in B&B, especially children. There are a number of people on the Labour front bench who grew up in temporary accommodation or got evicted that are working in the housing side of things. So that does give them real world, real life experience. Obviously, it hasn't stopped them from becoming members of parliament, which you can take a view on how good or not that is. But realistically, I think it's an incredibly difficult job that's drastically underpaid, and it's not something that I would want to do. So the numbers now from Q4 2024, 83,800 were assessed as homeless or threatened with homelessness and owed a statutory duty. 76,820 were assessed as being owed a duty. So there's a gap there of about 7,000 people per quarter who then I suppose have to do something else, either sleep rough, sofa surf, you tell me. 34,010 were assessed as being owed a prevention duty. Now that's down 2.7% year on year. So this drop in the summary that sounded good, it's only a 2.7% drop from a high, right? 5,820 of those were thanks to a Section 21, which of course some fools reading this data will believe this will disappear after the Renters' Rights Bill, but it won't, of course. And then 42,810 were assessed as homeless and owed a relief duty. 17,690 were accepted as owed a main homelessness duty, which was up 9.3% on the year before. So apparently we now allow government summaries of the facts to have a political bias to them these days, which is very, very sad. And as at New Year's Eve 2024, 127,890 households were in temporary accommodation, which is 13.6% up year on year. 13.7% up when you consider households with children, adult-only households up 13.3%. So that's why I shared as this week's image the percentage by circumstances, and in some parts it might be circumstances, it might be causes. These are often confused, misdescribed. Section 21 being the cause of homelessness is absolutely not. This is about treating root causes versus dealing with symptoms, which we do far too much of in the UK and politically in general around the world, because politics is reactive. It's not proactive, which is one of the big shames, right? So this is homelessness as currently defined. So no fixed abode. Council has a duty to house, not to be confused with rough sleeping, right? So plenty to think about there in terms of context. I'm sure you'll agree. And it leads me on to the shelter briefing that was also published this week around future trends in temporary accommodation. TA is costing $6 million per day. That might resonate with you actually, as that's about the same amount that asylum seeker hotels are costing per day at the moment. It was 8 million at some point in the Sunak administration. I believe it's now down to about 6 million. That's how we get to that 2.3 billion figure. Now, my view, there's nothing serious is going to be done about this until we get to about 4 or 5 billion, which it likely will do before 2030. Shelter focuses on the point that it's bankrupting local authorities, which is widely accepted. The number that Shelter focuses on is the delivery of 90,000 social rent homes over 10 years to end the housing emergency, as they prefer to term it. They're predicting 26% more children in temporary by 2029. This looks like a low prediction based on current numbers, I'm sorry to say. 44% more households. Well, if we're at 13.6% per year at the moment, again, that looks low. And the trends aren't falling away incredibly quickly. And new stock is at a cycle low during 2025 and 2026, because we know what the starts are, and the starts are really poor. And I'll come on to a bit of that later on. Now, that looks pretty grim before the planning reforms really kick in, right? So we need that to kick in. And then there's a couple of year runway before we really see any improvement. And this is all taking it out of context. All these other little things that come up that are, again, incongruent with what people are trying to achieve, such as, for example, if all new homes now need solar panels from 2027, that's another £4,000 cost to every unit that's built, plus inflation and tariffs if they're going to play a part, right? This is, that Shelter predicts temporary accommodation costs up to 3.9 billion by 2029. So not far off where I'm at if I'm saying 4 to 5 billion by 2030, right? Now, there's their weakest conclusion for some time as well about the abolition of Section 21. So basically, now they've got it to where they want it. Now Shelter's language looks like this. Although ending Section 21 evictions should limit the flow of people into temporary accommodation, the lack of social housing and affordable private rents, if unaddressed, could continue to drive up homelessness. Now, that emphasis is mine, of course, but should, I thought all the way through this was a guarantee. Section 21 was the evil. The landlords were the evil. It's all the fault of Section 21 and the landlords. No, seem to have given up on that line now because they knew it was never true in the first place, right? So, could continue to drive up homelessness. It's a cast iron guarantee. But as usual, we're not talking about root causes. We're treating symptoms, not causes. And the medication is more social housing. So they're calling for more spending on social homes in June's spending review. They're not wrong to do this. If the government wants to get anywhere near their targets, they must put the money into social homes, because the private sector will do what the private sector does. And it will build less if you need solar panels on every home, apart from anything else. So only 29% in the 2022-23 year that Shelter quote of those in temporary accommodation were able to move into a social let. That makes a temporary to social let life cycle almost as long as a typical private rental sector tenancy. How ridiculous, because about 23% of those turn over every year. So the councils do, of course, support people from temporary into PRS tenancies too, guaranteed bonds, first month's rent paid, all sorts of incentives. But that gets harder every year, of course. And Shelter also, lower down in the report, admit that insufficient LHA is part of the problem. They cite the crisis report I reported on a couple of weeks back. Only 2.5% of private rental properties listed are affordable under LHA. I can tell you from looking at the market very regularly that more than 2.5% of what's listed are at a very low standard indeed. In the past 5 years, privately managed TA has increased by 4.8 times. Yes, a 375% increase in 5 years. The B&B spend, which is far more emotive, as I said earlier, is up 110%. Now, those numbers, if they don't make you sit up and take notice, are truly eye-watering in more ways than one. So, on to the other end of the pendulum then. Savills' recent publication about England's housing challenge. I know they both start with S, but I don't think you can go much further than go from Shelter to Savills or vice versa, right? Now, Savs summarised the last 3 years, which is not a bad proxy for the next 3 years as it goes, because, as I say, 2025 looks like the bottom, really, and 2026 doesn't look loads better, but 2027 potentially brings significant improvement, although these solar panel rules, I'll say once more, are going to affect deliverability and viability once more. Net additional dwellings have averaged just under 230,000 per year, so 70,000 short of the 300,000 per year. So that 350,000 short of the 1.5 million target. Now, Savs believe the next 3 years will be worse because of the fall in the number of new home sales. And of course, just to explain this, house builders look at the number of sales of new build units to inform about how many units to put in the pipeline. They absolutely do restrict the supply. They don't just build everything they can as quickly as they can. They know they need to restrict the supply in order to make the margin that they want to. And they just hold on to the land otherwise, because there's limited downside in holding on to that land. It's usually going up in value in the background. It's just the way that house building works at the big level, folks, right? So that's the market for you, right? Now, I'm not sure we should compare too much to anything that happened in 2021, to be honest, because it really should be absolute analysis rather than relative analysis. And there is a bit of absolute analysis in here as well, so it does get better. But they think minus 26% in the past 3 years is where sales have been at. So, as I say, if we're benchmarking to pandemic years, we do need to be really careful, but new build homes down 26%. 2023, of course, will have been a bloodbath of a year because mortgage rates up really significantly, confidence shot, house prices going down, even first-time buyers are not that keen in a year like 2023, right? So, Savs are pressing for lifting affordability barriers and restrictions on mortgage lending because they know now is the time to make that call and lift the brakes on the housing market. The current new build delivery breaks back as about 66% sold on the open market, 27% is affordable, and 7% is purpose-built rental, so PBSA, purpose-built student accommodation for those who don't know, BTR, built to rent, and SFH, single-family homes, so homes that are built to rent homes. BTR is usually big blocks of flats, urban, or very, very, suburban, but very close to the city sort of stuff. So the OBR has forecast housing transactions moving from 290,000 per quarter, that was the end of 2024, to 370,000 per quarter by 2029. Now, this is based on planning reform and increased house building, but Savs have an issue with this, and it's a pretty fair point, to be honest, because demand is not equal to supply, although supply via new houses tend to flex to model demand. Sav's point is that the demand side is even more important, which I would agree with. And their seminal point is a 10-to-1 constant ratio between numbers of private market transactions and housing starts has persisted over the past 35 years if you ignore the Help to Buy distortion. So their argument would be, if you see the transactions happening, you can start new builds safely. The 2024 number for private house builders, who, remember, accounted for 77% of new build starts over the past 5 years, was 0.6 sales per outlet per week. So that's a key metric for the house builders. Back in the old days, when you said a third for the land, third for the build, third for the profit, for example, the expectation was 1 sale per outlet per week for a house builder. But this 0.6 is much more like par for the new world. The first quarter 2025 figures have come out from 3 house builders so far, and they're very much still in line with that number. Better than 2023, but 15% down on the 2017 to 19 market, which is that usual pre-pandemic yardstick, that pre-pandemic proxy, which I don't really argue with this approach. I use it myself, as you know, on a weekly basis. And that primarily because, apart from anything else, that 2017 to 19 market was pretty much unremarkable as dictated to by macro events. The Brexit referendum did not have a huge impact on the housing market. If it did, it might have knocked confidence a bit, but it also knocked rates down. So they probably balanced each other out, and it was normal for zero interest rate times anyway. Now, the annual rolling number of starts at this time by private house builders is just under 80,000. Yes, 80,000 at the end of 2024. If that's 77% of delivery, you can do the maths quite easily. It looks bad for the finished product housing completions for 2025, as I've said. Savills see this as increasing to about 110,000 new private starts by 2029. But again, we're way, way short unless social delivery is moving up very rapidly indeed. The next point is one that's made across the board, and we've observed in the supplement for at least 12 months now, the north-south divide. They're framing the local authorities who've seen a 10% plus drop-off in first-time buyer activity over the past 10 years have got an average price-to-income ratio of 13.31. The local authorities who've seen 10% upwards movements or more have got a price-to-income ratio of 8.05. So the reasoning is seen as the restriction under responsible lending rules introduced in 2014. Larger deposits, less ability to move in the more expensive areas. Now, the next part I've quoted directly because this is the push from the industry and the key to unlocking faster house price increases. The Financial Conduct Authority stated at the start of the year in a letter to the Prime Minister that it would begin simplifying responsible lending and advice rules for mortgages, supporting home ownership, and opening a discussion on the balance between access to lending and levels of defaults. Options could include reviewing how much first-time buyers are allowed to borrow and enabling lenders to issue more loans to customers with smaller deposits. So currently, remember, no more than 15% of loans can be at above 90% loan to value per lender. This could move, of course. The next suggestion for more targeted support for new build sales in areas where transactions have tanked sounds politically less likely to me, as it just means London. But if anyone's likely to do that, the Labour Party are the ones. Ultimately, London is a Labour heartland, so who knows? Savs report a positive institutional market, however. 63% of UK investors are looking for greater investment in multifamily and 52% in the single-family suburban market. The UK is the highest priority market for European-based investors too. The indicators there are for 23 billion to be invested over the next 3 years in living in the UK. That's versus 14 billion over the years 22 to 24, mostly forward funded, which has been about 75 to 85% of all BTR over the past 3 years because there's limited operational stock available to trade. It needs building before it's going to change hands much. You do see very, very few of these portfolios change hands. They normally make big headlines when they do. There's really not a lot of it going on because there isn't that, the amount of stock just isn't that thick. 100,000 odd units in the whole of the UK we're talking about at the moment, although that is moving up pretty quickly. Now, affordable average is about 56,000 homes per year, right? Which is a 50-50 split between grant funded and then nil grant Section 106. So they know that increasing this is absolutely key. And I think everyone across the board would agree with this. Otherwise, there's no chance of making a dent in this deficit to the 300k a year target. Now, the 2 billion of funding that you might remember having been announced in the spring statement, and some was mentioned in the October budget as well, for 26-27, all that is a continuation of the current affordable homes programme. It isn't new money compared to the status quo as at today. So without new money being announced, all we're going to get is a contraction, realistically. And then non-grant funded delivery has 14.8 billion of investment forecast. That's 5% below the previous quarter and the lowest amount to be spent on new affordable housing since the start of the pandemic. At current times, without significant injections, the SAVS forecast for 2029 is down to 40,000 affordable homes per year. And again, that forecast will have to change as and when any money is put into it by Rachel Reeves. But I'm sure, I can imagine in the background, Angela Rayner is screaming for it and Rachel Reeves is not giving it to her. So let's see who wins that arm wrestle. Now, I've said this in far less eloquent terms than Savills have put it. We need tens and really 100 billion or more to be injected into the sector. And we're messing around at 2 billion a year. There's no real appetite to make a difference unless this money gets a really majorly shot in the arm come June at the spending review. Now, my view would be, under the fiscal rules framework that Rachel Reeves has put in place, this can happen, right? Because it can be used for investment if the argument is made about investment. And this is investment in society. It has all sorts of positive knock-on consequences, right? By having, and there won't be enough social housing. There'll be nowhere near enough. But having more social housing, fewer people in temporary, there's the immediate level one argument that it's going to cut down the amount of money being spent on temporary accommodation, right? It's not going to stop it from growing because we're not going to get to enough. There's no chance of us doing that within this parliament, right? But it is still going to cut that down. But then there's a second order consequences of what it means to those families, what it means to the people who grow up and don't have to grow up in temporary accommodation, has massive health outcomes, cost or saving benefit to the NHS. These savings are huge. They need quantifying and they need taking seriously. And borrowing money to do this absolutely makes sense, especially with yields coming down a little bit. It makes a huge amount of sense. It bolsters balance sheets of local authorities, of central government, depending on how you structure all of that. They can borrow cheaper than anybody else. It makes sense, right? Make no mistake about it. Where does Savs get to then ultimately anyway, after that little segue? 205,000 new homes per year for the next 5 years as an average. So their conclusions are pretty clear. You've got to do either or both of these. Take the brakes off the mortgage lending regulations, mostly biasing that towards first-time buyers. Stick the fuel in the bottom of the pyramid. Makes sense because it percolates upwards throughout the whole of the housing market. Or whack a ton more money into affordable/social. I can't pick any holes in either of those conclusions, even if I made a few pedantic points around the outskirts. It does all read very well to me and appears to be accurate and a fair summary. So I'm going to come to the conclusion once more. Remember to book your tickets for that 3rd of July, Thursday the 3rd of July workshop in London, Property Business Workshop, joint ventures, mergers and acquisitions, all your questions answered on that subject from people who have done 8 figures and still are exceedingly active in both the joint venture and the M&A space in property and a little bit beyond as well. It'll be a fabulous day of learning and discussion, and the guest list alone is worth coming to these days for because we do get some fabulous attendees. Your super early bird tickets with a genuine 20+% discount are available. Links in the comments or bit.ly/PBWSEVEN. So above everything though, please remember to keep calm. Always listen to the supplement, of course, and carry on because there's opportunities abound this year and we go towards 2030. And the risks around at this time, whilst they might feel significant, some of these geopolitical ones, they're far less meaningful to the UK housing market than they have been for several years before this. Of that, I have no doubt. Good luck and thanks for tuning in.